In this video, I'm going to go over the Foundation 15 problem for Chapter 9 on flexible budgets and performance analysis. We are given information about Adger Corporation. It is a service company that measures its output based on the number of customers served. So this is going to be what is going to drive our budgeting. The company provided the following fixed and variable cost estimates that it uses for budgeting purposes and the actual results for May as shown below. So here's the fixed elements per month for salaries and for other expenses. And then this is the variable element per customer served for the revenue. In other words, this is what we charge each customer on average. This is what we pay on average per employee and travel expenses. And then these are the actual amounts that, in this particular case, they're showing them to us, next to what the estimates were. But keep in mind that usually we have this information first, the estimates, and then at the end of the period or a little bit after, we find out what the actual results are. So it's as if now we're doing the analysis post budgeting. Okay, so we did the budget prior, and then now we're finding out what these results are. So keep that in mind so that you can see the more realistic angle to it. When preparing its planning budget, the company estimated that it would serve 30 customers per month. However, during May, the company actually served 35 customers. Okay, so we're going to have probably, based on this information, a favorable revenue variance. In other words, we ended up serving more customers, so that's more revenue. But we'll get to that. All computations pertain to the month of May. All right, so number one says, what amount of revenue would be included in the flexible budget? Okay, so we're told, so I'm going to put in here flexible budget for revenue for the month of May. Okay, so we have that the variable component of revenue, the variable amount was $5,000 is what they told us. So let me put this right here. And then our actual activity, since this is a flexible budget, we're still going to use the unit cost or the unit amount based on the estimate, but then the flexible budget would reflect the actual results. Okay, so I'm going to go in there and say actual activity, because this is the flexible budget. The original budget would have been 30 times 5,000, right? So that's the original budget. Now this flexible budget is going to reflect the estimated amount per unit, but based on actual results. Okay, so this is going to be 35, and then we'll call this flexible budget revenue or budget revenue for the flexible budget. Okay, so we'll multiply this out. Put some dollar signs on this just so it looks a little better. And that's what we have. So on the flexible budget, we'll see a budgeted revenue amount of $175,000. And you'll see this pattern happening for the flexible budget. It's going to be based on budgeted amount per unit, whatever that unit is. In this case, it's the sales, right? Times actual amount of units. And that gives you X, whatever that may be, but that's sort of the pattern that the flexible budget will follow. Okay. All right. So now we go to number two. What amount of employee salaries and wages would be included in the flexible budget? Okay. So again, let's go in here and use that same pattern. So there's going to be flexible budget for salaries and wages in May. Okay, so we have the variable amount per employee. They told us it was $1,100. That came from right here. And then it's based on the number of customers served, so that's going to be actual activity. That's 35, so we'll multiply that out, and this will be the variable amount, variable total amount. So let me calculate this. And that's 38,500. Now, with the labor component, we also have the fixed amount. So now we're going to do the fixed amount, and that they told us was $50,000. So that's not going to change independent. It's going to stay the same independent of how many employees we have. And again, that's within the relevant range, of course. After you can, all the analyses that we're always doing are based on a range that is acceptable for the analysis. So we're going to call this one the budgeted, flexible budget salaries and wages, which is a total of the summation of these two, 88,500. Okay, and all these components are going to be used next for our actual income statement, the budgeted flexible budget. Okay, so now let's look at number 3. What amount of travel expenses would be included in the flexible budget? So travel expenses are just one variable component. So let's go ahead and do that. Flexible budget for travel expenses in May. So we have again the variable amount, which they tell us is $600, and then the actual activity is 35 customers, I'm sorry. So then this is the budgeted travel expense. Okay, so let me do this computation, and it's $21,000. These are the components for our budgeted income statement. And what will happen is that we will set this up where this flexible budget, these amounts, are going to be compared to the actual dollar amounts. And then the differences are the variances. Okay, but for your budgeted flexible budget, you're going to always use this pattern right here where you base it on the budgeted amount per unit. If you notice, this was the budgeted amount per unit. This was the budgeted amount per unit. Same thing here, but then you multiply times the actual amount. So this is the actual activity, and that's the pattern you're going to follow throughout. Okay, number 4, let's see. Number 4 says, what amount of other expenses would be included in the flexible budget? Now, this is just a fixed amount, other expenses, so that's just going to stay like that. So other expenses is $36,000 fixed. Okay. Next we have 5. This is where we bring it all together. We have, what is the net operating income of the flexible budget? Okay, so let's look at that. So we have revenue, which we said was 175. Then we have employee salaries and wages. So we'll put that here. And that one was 88,500. Then we have travel expenses. That was 21,000. And then finally other expenses, which was the 36,000. So when we get the result here, we find that the net operating income is going to be, bear with me as I subtract these out, 29,500. Okay, so this is our flexible budget. I'm going to put a better title to this actually. This is the flexible budget at 35 customers served. the original budget would have been based on 30 customers served. Okay, so if you were to grab the original budget of 30 customers served and compare it to the actual results, then you would not be comparing apples to apples. Okay, so you need to modify the original budget to 35 customers, and that's what we did right here. So that now when we compare to these numbers, then we can see apples to apples. In other words, this is based on 35 customers served, and this is a budget based on the fact that 35 customers were served. So that's comparable. So then the next questions are going to ask us about the revenue variance, the salaries and wages variance. In other words, the variances between these budgeted amounts of 35 customers and actual results. So I'm going to do that next to this here. So this is going to be 6. I'm going to call this variances. So actual results were revenue, let me write them down. Revenue of 160,000. This is actual results, right? Employee wages were 88,000. Travel expenses were 19,000. And other expenses were 34,500. Okay, so somehow even though we served 35 customers, it appears that we maybe had to give discounts somewhere along the way. Wages were pretty much the same. Travel expenses, we saved a couple bucks there. And then other expenses, oops, I did that wrong. Travel expenses were a little bit lower than what we anticipated. So the variances here are going to be as follows. So this is an unfavorable, or my bad. Yeah, unfavorable, because we ended up getting less revenue than we originally thought. And let me copy these down. And for all of these, the actual amounts were lower, so all of these were favorable. So in other words, we budgeted 88,500, but then it ended up being 88,000. So all these are favorable. So our revenue variance is unfavorable, but then our expense variances are all favorable. We ended up saving some money. So just to be clear, this is 6 through 9. Okay, so I'm going to put in here 6 through 9. That response is to 6 to 9. Now, again, this flexible budget is based on this formula here. Let me copy it down. Okay, I'm going to put a little box around this. Bear with me here to emphasize this, because I think this will help you out. I'm going to put a little arrow here. This is for this. Okay, that's always going to be like that. And then the actual results are whatever they are, of course. This is going to be actual amounts of dollars times actual production level or sales level, I'm sorry. But ultimately, it's whatever the amount is, okay? All right, so let's look at now number 10. 10 says, what amount of revenue would be included in the company's planning budget? In other words, the planning budget would have been the original budget. So in the original budget, we would have done the same thing as this, but not based on 35, instead based on 30. This would have been 30. Variable amount per customer times actual level. That would have been 150,000. But if you would have compared 150,000 to actual results, you would not be doing the right comparison, because this is based on 30 customers. This is based on 35 customers. And hence the importance of doing the flexible budget. 35 customers versus 35 customers. That's the way we want to do it. All right. And I think the next 4 questions are asking the same thing for the other components. Salaries and wages, travel, and others for the planning budget. So they're all going to be based on 30 hours. Okay, so I'm going to do 11 here. Let me copy this here. So 11 is regarding salaries and wages. So it's still 1,100 per employee, but it's not based on 35, it's based on 30. So under the planning budget, or, oh, I should change this, I'm sorry. This is no longer the flexible, this is the planning, or just to remember the original or ex ante budget. Before we knew that we were going to sell 35, we did this budget. So it's called planning budget. But at this point, this planning budget basically is irrelevant, okay? It's no longer usable for us, even though that's where we started. And that's what they're trying to show us, okay? So this 1,100 times 30 gives us 33,000 variable salaries and wages. The fixed amount stays the same, so that's $83,000, okay? So 12 is asking us for travel expenses. So I'm just going to copy what we did already. Top here, flexible for travel. But again, this one's going to be called the planning budget based on ex ante information. I'm trying to drive that point across by emphasizing this, okay? This was before, and it was 600 times 30. And so initially we thought our budget and our budgeted travel expense was going to be 18,000. But since we sold more, that went up to 21,000 based on the flexible budget. Okay, and then 13, what would other expenses have been? Well, that would have stayed the same because it was all fixed. So let me just write that down. The planning ex ante budget for other expenses that would have just been the same as before, $36,000, because that was fixed. Okay. Okay, now moving on to 14. Under 14, they're asking us about activity variances with respect to revenue, and then and 15 is with respect to all the other expenses. So maybe I should be a little bit more clear here, okay? The variances that we just did are spending variances, okay? So let me go over here and emphasize that. So these right here are spending variances. And I'm going to highlight this in yellow and explain right here that the spending variances, even though we did this already, I'm going to just be more clear. These are based, the comparison of flexible budgeted amounts versus actual. So since we are looking at the same sales level or activity level, we're looking at a budget based on actual results or actual units, let's say, but it's still a budget. Whereas this is actual. So since we're looking at the same level of sales or of whatever drives your budget, then any differences between these two are because we spent more or we spent less, right? That's the idea with the spending variances. So contrast that to what now we're being asked for. We're being asked for activity variances. So I'm just going to, first of all, let's go ahead and just call this 14 through 15, and we're going to call these activity variances. And then the activity variances, they're going to be a comparison based on your planning budget. In other words, the one I called ex ante budget versus your flexible budget. Okay, and the idea with this comparison right here with the activity variances is that now we're saying any dollar amounts that differ here are not necessarily dealing with the fact that we spent less or more. It's more dealing with the fact that we sold more or less than what we originally planned. And that's why it's an activity variance. Okay, so let's go ahead and do all of them here. Let me copy this down because we'll use that. Okay, so this was, well, actually I should have copied the values. 1 second. Okay, so this was the original flexible budget. Sorry, I'm jumping around a lot. So this is our flexible budget here. Maybe I should color code this a little bit. That would help us out. And now what I'm going to compare it to is the planning budget. So the planning budget, or ex-ante budget, those are the numbers we just came up with here. So the budgeted revenue was 150,000. The budgeted salaries was 83,000. Travel expense was 18,000, and then the other expense is 36. So let's go ahead and write that down in here. So I'm just copying these down, the ones we just did, and then this is 36,000. And just for the heck of it, we will do the planning budget net operating income, which we thought was going to be 13,000. Okay, so this would have been the budget if we would have sold to 30 customers, right? That's the planning original budget, but things changed and then we ended up serving 35, so that's what this is right here. Let me change the color here so we're pretty clear as to what we're talking about. Sorry, I take a little bit of time here with the coloring, but I think it's good to be able to visualize what we have. So then when we look at the variances, we're going to do this minus this, and then just copy throughout. Okay, so this $25,000 variance is favorable because we ended up having more revenue than we planned for. Now, that's not an issue of spending. That doesn't arise from us being able to charge more or less to our customers. That difference arose from the fact that we sold more. This is based on 30 units. This is based on 35. So that's why we call it an activity variance, right? And then these right here, this is unfavorable and unfavorable because we spent more. But if you think about it, calling this unfavorable can maybe be a little bit misleading because the fact is we ended up having more customers, and that's always a good thing. So if we have more customers, we're going to spend more on expenses, right? So be careful how you analyze this. This is an activity variance, all right? And then this is, just net zero, so there's no difference there. Okay, so just to re-emphasize what we have here, the spending variances are a comparison of flexible budget versus actual results. And then your, let me see if I can, your activity variances, let me highlight them in a different color. Those are going to be a comparison of your flexible budget versus the planning budget. And I like to think of this, when I look at the activity variances, I like to think of it as I'm comparing something based on a level of production or a level of sales that is different than what I originally thought. And that's why it's an activity issue, okay? It's an activity comparison. And so in a sense, you're not comparing apples to apples here. Whereas when you come up with the spending variances, those are related to comparing apples to apples. This is based on 35 customers, and the actual results are based on 35 customers. So any difference here is because we spent more or less. Okay, this concludes the video for flexible budgets and performance analysis.